Hello class and welcome to our today's lesson. In our today's lesson we are going to talk about the accounting treatment on depreciation. This is a continuation of the topic that we are handling on a depreciation. First of all, which is actually a reminder of what we did last, is a discussion whereby we said or we described what depreciation is. We started by saying that depreciation is actually the loss in value of a fixed asset. Remember, a fixed asset, from the definition that we had during the introduction of this particular unit, we said that a fixed asset is an item or a resource that is useful to the business and is going to remain in the business for more than one financial year. And the intention of having that particular asset in the business is not to sell it, but to generate income or using it, or to assist the business in generating income. By the fact that the asset remains in the business for more than one financial year, you find that as it is being used from one year to the next, that asset will be losing value. That value that is lost is actually supposed to be charged as depreciation in the books of accounts. And because we are using that asset to generate income, the loss in value of that particular asset is supposed to be debited in the income statement. Class, just note here, anytime you find a case whereby you are told that you debit the income statement, you are simply being told that you treat that amount as an expense. So when we are treating depreciation as an expense, that's why it is debited in the income statement. So anything that is debited in the income statement is actually an expense. And that now tells you that depreciation is considered as an expense in the business, and that's why it is debited in the income statement. To complete the double entry, the same amount that is entered in the income statement is credited in the provision for depreciation account. That account is also known as the accumulated depreciation account. That account of provision for depreciation account is also known as the accumulated depreciation account. Now, our first case that we are going to discuss in this particular lesson, it is the accounting for disposal of fixed asset. Whenever there is the word disposal of fixed asset, I want you to note that the asset is not in use anymore in the business. So, whenever an asset is said to be disposed, just know that the asset is not in use in that particular business to generate income. And the asset is going to be disposed in three ways. Either the business has sold the fixed asset. Note that the fixed asset is also known as the non-current asset. I hope you have not forgotten that. If the asset is sold, then it has gone out of the business and it is not going to be in use anymore. Number two, if the non-current asset is written off as a result of damage, meaning that the asset has been damaged in a way that it cannot continue generating income to the business, or through accident or maybe theft. Then the third and the final case is when the asset is scrapped. When we say that the asset is scrapped, we simply means that the asset is like it is so old that it cannot be used anymore in the business. It is there, yes, in the business, but it does not have economic value. Either it is in the store and it is not used, or it is put somewhere outside and actually it is not being used in generating revenue for the business. I want us now to see, in these three cases, how do we deal with the recording? Let us start with the sale of the non-current asset. If the asset is disposed through sale, then it simply means that that asset is going to generate some income into the business at the end of the day through the sale. So this is how we deal with it. One is to remove it from the books of accounts. If, for example, it was furniture that was bought 10,000, you remove it from the list of furnitures And how do you remove it from the list of furniture that the business has? When that asset was bought, it was debited in the furniture account. Now that it is gone, we credit that furniture account or the asset account. Remember, here we are using the asset account because fixed assets are of different categories. It can be a motor vehicle account, it can be a machinery account, it can be furniture account, things like that. So we say we credit the asset account. Why are we crediting it? We are crediting because it is now gone. When it was being added, it was debited. Now it is gone, it is credited in that particular account. Then we complete the double entry by debiting the asset disposal account. And note here, very important, what are you going to use to debit and credit this? It is with the cost of the asset. The cost of the asset here, we mean the acquisition price, the acquisition cost, not the amount that you have sold. It is the amount that you bought that asset with. Note that and note it clearly. Then the other entry is going to be, we debit the provision for depreciation account, and then we credit the asset disposal account. Then remember here, when we talk about the accumulated depreciation here, we mean the total depreciation from the time of acquisition to the time of disposal. From the time of acquisition to the time of disposal. So you put it or you record it there. Then the third case, you will record now. Remember, when you sell something, you are going to receive some money. That money will come into the business in form of cash or check. If it is in form of cash, we shall debit the cash account. If it is in form of check, we are going to debit the bank account with the amount received on disposal. Then we credit the asset disposal account. Then we are going to also debit the asset disposal account with the profit. How are we going to know that you have generated profit here? Remember, we have got this. The asset was bought at a cost. It has depreciated over years up to the point of sale. If, for example, it was a furniture which was acquired, that is the cost now, it was acquired at 10,000. It has been used for 3 years. In those 3 years, the total depreciation maybe has been 3,000. Meaning that it had a cost of 10 and now it has lost 3,000. Then it simply means that it has a net book value of 7,000, which is actually 10 minus 3,000. That asset, upon disposal through sale, it can either be sold at 80,000. Note here, it was worth 10,000 at the point of purchase. Then it lost 3,000 for those 3 years it was in use. Then it had a net book value of 7,000. If the asset is sold at 80,000, then it simply means that there is a profit that is realized on a disposal, and that profit is actually 1,000. Because it had a net book value of 7,000, but we have managed to sell it at 80,000, then there is that 1,000 which is a profit. That profit is actually a gain. It is actually a gain. That profit of 1,000 is supposed to be debited on the asset disposal account and credited in the income statement. I want to bring your attention here on crediting the income statement or the profit and loss account. Remember, I told you here, when an asset is actually depreciated, that amount is considered as an expense and it's actually debited here. When we debit, we say it's an expense. But when we come here and we credit, the income statement, it is the other way now. If it is crediting the income, then it means that money is coming in, and that is actually an income to the business. So because it is a profit on disposal, we normally credit here on the income statement. And then we are going to see the last scenario whereby we are going to record now in the income statement if it is a loss. You find that if it is a loss, you debit it here as actually a loss, and then you also record it on the asset disposal account on the credit side. Non-current assets that are actually damaged or actually stolen, you'll find that these are the accounts that are going to be involved. Number one, debit the asset disposal account with the cost. Always you debit with the cost. Why are we debiting with the cost? So that we can credit that asset with the same cost, so that we can remove that asset from the list of assets that business has. Then we are going to debit the provision for depreciation with the accumulated depreciation. Remember, accumulated depreciation is the total depreciation from the time of purchase to the time of damage. And then you are going to credit the asset disposal account with the same accumulated amount. Then if the asset was actually insured, then we are supposed to receive some amount from the insurance company. The amount that we are going to receive from the insurance company, or we expect to receive from the insurance company, is actually going to be debited. This insurance company is actually like our debtor. That's why we are debiting, because we are expecting that amount, and then we credit the asset disposal account. Then number D is the asset disposal in case of actually maybe a profit. If a profit is realized as a result of a damage and then compensation, then we debit the disposal account, then we credit the income statement by that profit that has been realized. But if it is a loss, it's going to be the vice versa of this. We debit the income statement because it's a loss, it's like an expense, then we credit the asset disposal account. If, for example, at the end of the year, the insurance company has paid, meaning that money has come in form of cash or check, then instead of the insurance receivable, we can substitute it with the cash or bank, and then we debit it here, either cash or bank, with the amount expected, and then the asset disposal account. So the non-current asset that is scrapped, meaning that it is not in use, the accounting entries are going to be just like this. Debit the asset disposal account with the cost of the asset no longer in use. Then we credit the asset account. Remember, this entry number one is to remove that asset from the list of assets, meaning that now you are actually crediting the account of that asset, because when it was bought, it was debited. Now we credit. And I want to remind you here, when we debit and then we rate a credit, it's like we are minusing that account. Then we debit the accumulated depreciation from the time of purchase up to the date of scrapping that asset. We get the total amount, and then we credit the asset disposal account with the accumulated depreciation amount. Then if the asset is actually disposed at a profit, then you find that you are debiting the asset and then we credit the income. But if it is a loss, the vice versa. We are going to demonstrate that using this example 8.4. which says that a business firm started trading on 1st January in the year 2023. On 1st April, it bought a new motor vehicle costing this, and later on 1st July, it bought another motor vehicle costing this. The financial year for this business ends on 31st December. It has a policy of depreciating motor vehicles at 20% per annum using straight line basis. What you are required to do here as a student is to prepare the motor vehicle account, the provision for depreciation account, the income statement extract, and the cash or bank account extract. So this is pretty simple. What you are supposed to go and do here is to realize here we did not have any disposal, because we are not told whether the asset or one of the assets or any asset was sold. We don't have a case of damage, we don't have a case of scrap. So in all this case, it's acquisition. So because they are acquisition, we shall open the motor vehicle account and we debit the two figures, but separately. You debit, the first one is 1st April, you put the figure here is 400,000. Then below it you write 1st July, you put it here. So the balance for that year, we are going to have 400 plus this one, which is actually 950,000, like that. When we go to the depreciation now, we need to calculate. I want us now to figure out this question, and when I will do the next video for the next lesson, I'm going to illustrate actually using now the solved accounts how this was done. I hope you have enjoyed this. Actually, depreciation is actually one of the areas that you also need to understand, because very rare will you find an examination without this particular section. Either you prepare this or it's actually an income statement, but you need to determine the amount that goes there as an expense for the accounts that have been depreciated. Otherwise, I know you are going to understand it much better and much clearer when I will come with the next video with a solution to this particular illustration. Thank you and enjoy your moments.